I'm Marilla Fernandez. Thanks for joining us today for Market Call. Richard Fogler is on the show. He is Managing Director at Kingwest Company, and he's taking your questions today on North American equities. Here's how to reach us. Call us toll free, 1-855-326-6266. You can also send an email to marketcall@bnnbloomberg.ca. Richard, thanks very much for coming in.
A pleasure.
We had GDP numbers out for both Canada and the U.S. at the start of the week. As you know, we are seeing some of the decline that has been largely expected. Do you feel that the trade war was beginning to settle in there and we're going to get sort of much worse numbers in the next quarter ahead?
So I'll give you a contrarian view. I like
okay.
that. There is no trade war.
Oh.
There is just Trump mouthing off. He has said he's going to do a bunch of things. Other people are saying they're going to respond in varying ways. Nothing much has happened. Lots of talk. It has seriously impacted the GDP numbers. As you noticed, the consumption and business sector and the consumer sector was okay in the United States, but the import sector was terrible, and consequently had a slight decline in the GDP number. And that's bad. The fact was, it was mostly because people were pre-ordering, pre-buying, increasing imports prior to tariffs. Trump kills the tariffs, makes deals, what he'll call making deals. All that stuff goes away. The big thing is the response to his trade war has been universally bad. It's been universally bad from his people, the MAGA people. It's been universally bad to consumers. It's universally bad to businesses. It's universally bad to investors. And if there's any other group that I missed, it's universally bad to them too.
Okay.
And so, he's going to have to correct it. That would be my expectation. But his people have announced the first 100 days was all about about tariffs. And the next 100 days are going to be, this was their statement, not mine, it's about trade deals and tax breaks.
Okay.
So trade deals are all dependent on what he decides to do. They will happen. You'll see them happen because whatever somebody agrees to, he's going to say that was a great deal. I beat them up and look what they've done for me.
Well, that's his line for pretty much anything, right?
Absolutely.
It was what I meant to happen, and isn't it great? Okay, let's talk about.
That's exactly right. And it's magnificent, marvelous, the best ever.
Absolutely the best ever. Let's talk about the new prime minister who is now in place. Donald Trump saying, we're great, love him. We're going to meet, in a week. And have a lot to talk about. Do you see that as the beginning of the unwinding of all of this? As you alluded to, you think this next 100 days will be about cementing some pacts?
Trump, for some reason, hated Trudeau. And apparently likes Carney. Why that is, I have no idea. I got a bit of an idea why he didn't like Trudeau. But the big thing is, Canada is really simple. Canada, if you look at the United States and Canada, per capita GDP from 1990 to 2015, there are two lines like this. They're right on top of each other, absolutely identical. From 2015, they start to diverge. And Canada went straight sideways. The increase in per capita GDP since 2015 is 1.1%, not per year, total. In the United States, it's 52%.
Why?
Because of Canadian policy. This is not lost on anybody, including the new prime minister, and I would expect that economic policy will be his number one agenda, economic growth will be his number one agenda, and that they will fix this because, Canadians didn't just get stupid 10 years ago. It was policy, not our private sector that screwed up. It was policy that screwed it up.
Yeah, we're hearing a lot about policies that need to be unwound.
Exactly.
Or somehow just done
away. And so I think, we're really positive on Canada because we think that's going to happen.
Okay.
We think that's a really good bet.
Okay, you're the first out to say that, so let's see what happens.
As I said, I like to be contrarian.
Richard Fogler joining us. He's Managing Director, Kingwest Company. He's going to take your questions today on North American equities, so we will line up your phone calls as we take a break. Back in a moment. Welcome back, and thanks again for joining us here on Market Call. Let's get to your questions. Stan has written in. He says, I'm wondering if I should add to my position in BMO. Some of the financials got sort of in the drag down, caught up in the early start of the year. Let's have a look at where BMO is today. They're at 132.71, so they're up a little bit on the day, but down from the start of the year. Would you dip into BMO?
It's got crushed since the beginning of the year. It's going to earn $12. It's trading $132. Not very expensive. They've got a dynamic U.S. business. They've got a really good CEO. It's not cheap. As long as you take a multi-year view, I don't think you can possibly go wrong.
Okay, so it's something you want to dip into now, but you're going to hold it for a long time.
We hold everything for a long time.
Got it.
We hold everything 5 years or more, or plan to.
Got it.
So
5 years is
that's a long time.
Yeah, I think some people think long term. They're thinking 10 years or more. So 5 years should be easily doable.
Yeah, we do. We own, I think 30% of the stocks we own, we've owned over a decade. Some over since the 90s.
Oh, wow. Okay. That's a long time.
That's a long time.
Let's go back and get to a phone call. We have John on the line from London, Ontario, and he has a question today for you. John, what's your question?
Thanks, Mel. Hello, Richard. I appreciate your straightforward advice and your contrarian attitude. I hope you're right. Our youngest just turned 18, and he's got some money in registered accounts that he's going to meet the two-headed beast called the market. We have two Mag 7 stocks reporting today, Apple and Amazon. I'm a firm believer in the Amazon business model. Is this a good time for this young man to get in and buy and hold? Thanks very much.
So a lot of headwinds generally for the tech companies.
Exactly, and it's the consumer-related companies, Apple and Amazon, that are taking it on the chin. You notice that Meta came out today, earnings were great, revenues were up 20%. Apple came out last week, same thing, cloud business booming. Amazon's got plenty of that, so that's good. Amazon's retail business taking it on the chin a bit in the near term. Cloud business is great. Yeah, it depends on to a certain extent, you have to take a look at and Apple's going through a bit of a transition. Can they produce in the United States? Can they not? From what I understand, and I'm not an expert, it'll be tough for Apple to move a lot of manufacturing in the United States. Cost will zoom, a phone which costs, I don't know, $1,200, I think, in the States today.
Will go up dramatically.
It's going to go up to something like, I've heard between $2,500 and $3,500. I don't think that would be a positive for sales, and they're getting crushed in China, which was a big market because Huawei has introduced stuff that's equally as good, and it's Chinese opposed to American, and because all this nonsense, they, like Canadians, have become much more nationalistic, and so
do they have the greater headwind then compared to Amazon? Amazon, we think, always bringing stuff in from China. So they've got that exposure as well. But would you say Apple is kind of harder hit by all of this trade war overhang? Okay,
so, I mean, the question is a couple of things, how it all unravels. I mean, it's two things. One, how it unravels and how long it takes to unravel. The Amazon imports things. They don't make them, Apple stuff actually is made there. They got to get Foxconn, who makes a lot of it. Factories are in China. They've opened a factory in Texas. They're making no phones because they can't do it. They can't do it efficiently.
Okay.
It's going to be tougher for Apple to amend its ways. Amazon could buy stuff from Vietnam. They can buy stuff from Indonesia. Some guy makes them. Like right now, all tennis rackets, for example, are made in one plant in China. Every brand except Yonex. They could move that probably pretty quickly.
Okay.
The iPhone, a little more complex, a little more, and huge, more tougher.
Okay, so it sounds like you would go the Amazon route if you had both of these to choose from, and is now a good time as they are still sort of down from the start of the year?
Yeah, I mean, we don't own them, so I can't really comment.
Sure.
I can't give advice what I would do, because I can tell you right now what I do, which is I'm not doing anything. So from that perspective, no, but if I were doing one or the other, if that was my choice, I think I'd probably do Amazon.
Got it. Let's go back to the phone lines. Reg is on the line. He's calling from Winnipeg today. Hi, Reg.
Good morning. Thanks for taking my call. My question for your guest is, every once in a while I phone in on Manulife just to give it some oxygen, because we talk about the banks a lot on BNN. So let's give a little bit of oxygen to Manulife. Now, the thing that I kind of scratch my head on Manulife is that They reported their earnings last quarter, beat the analyst expectations. One would assume when you beat analyst expectations, you get rewarded, the stock goes up. In this case, it didn't. It went down. Next week, they report again that on the assumption that they beat analyst expectations again, and a lot of these banking analysts that have dragged their feet on re-rating Manulife, I find it curious when, the biggest insurance company, probably the most diversified insurance company in Canada, good dividend metrics, very low PE relative to the banks. Why doesn't Manulife get more traction here? Because I find at the end of the day, you see a lot of these bank and financials that own the shares of Manulife selling the shares and then trying to buy them back at a cheaper price. Can you answer that? Thank you.
Thanks very much, Reg. And what's your take on Manulife? And I guess Reg is saying it's not doing as well as he thought it was going to do given where they're at.
So I think there are a couple of things. One is, the insurance business is not what I would call what I would call a business that's expanding dramatically. Assuming that the dividend, they pay a dividend, that just means they don't have money to reinvest in the business. They don't have money. Why don't they reinvest in the business? Because they don't have the place to do it to earn high rates of return on capital. If you look at Berkshire Hathaway, they don't pay a dividend because of that. Warren Buffett wants to reinvest in things he can earn a high return on. We're not too keen on, we don't think dividends is a reason to buy things. Nobody, like buying something for a 4% rate of return for the rest of your life is, even with the tax break you get on dividends, not much of a return.
They are expanding in other markets, though, right?
They're expanding in other markets. They're doing a pretty good job. I think they're doing a good job. It's just, there are other things you can do in the financial services business that are actually either really renovating or transforming their business relative to everybody else and consequently able to catch real market share and from smaller business. These are very large businesses. How much do you think they're going to get bigger over the next couple of years, and how much would you want to pay for that?
Yeah.
And so that's the problem with Manulife. And then these are highly regulated businesses. While that in many ways keeps your revenue, your business steady. And then there's the third thing, which is interest rates have an impact on insurance companies and banks, and on insurance companies in particular. Higher interest rates are a negative because it makes the liabilities they have more expensive relative to their assets. So as interest rates rose since the last quarter, to Red's point, as interest rates rose, the 10-year bond yields rose to 4.8% in the States from 3.5%. That's a negative. That's a negative impact to Manulife's value because it's making the liabilities, what they owe on their insurance contracts, more expensive relative to their assets. So that counteracted the analyst estimate. The current 3-month estimate made the valuations low.
Got it. Okay, we do have to take a quick break. Richard Fogler is Managing Director, Kingwest Company, taking your questions today on North American equities. We're lining up your questions as we take that break. We're back in a moment. Thanks for joining us again on Market Call. We want to get right back to your questions. We're going to start with an email. This one is coming from Nathan. It says, what are Richard's thoughts on Couche-Tard? Couche-Tard, of course, working to try and buy the 7-Eleven from the Japanese parent company, at least in the United States. There was some movement on that today, but it's been very slow. What's your take on Couche-Tard overall?
In simple terms, great business, great management, expensive.
Expensive. Okay.
And we don't invest in high-priced companies, so it would be something that's off our radar unless the price changed a lot. They generate $6 billion of cash flow. They could pay half that goes to capex. Last year was no acquisition, so it's pretty. So they generated $3 billion. Market cap $67 billion, 20 times.
So they're down now. They're down to 74.
It's down quite a bit now, but it's still not cheap enough. It hasn't come into our range. So it's now a big company. We buy companies where they have a massive market opportunity in front of them. These guys are big. The thing that has generated their revenues over time has been taking out mom and pops and building and now buying out 1 or 2 mom and pops doesn't move the needle. They're too big. They got to buy big things. That's why they're looking at 7-Eleven. 7-Eleven a great opportunity, but it's Japanese. The Japanese are very nationalistic. They didn't need Trump to force them to do that. Who knows how they will react to this? And then you've got, will the U.S. react to the to whether they take over 7-Eleven in the U.S.? They are very large. It takes another huge chunk. There are concentration concerns, Sherman Act. And also, there's Trump. Can a Canadian company take over a U.S. company? Who knows how he's going to?
Yeah. So there are many obstacles before that.
So there's lots of lots of water to flow under the bridge before this deal happens. It's a great deal if they can do it.
Got it. Okay, let's get to another email from Peter. He says, do you see BCE cutting their dividend, and should I sell if they do? BCE, we remind people, a parent company of BNN Bloomberg's channel here under the Bell Media banner. And there's been a lot of talk and a lot of folks saying they should cut their dividend to deal with their debt and other things. What's your take? Will they?
Can I say anything not positive because you guys don't?
Absolutely.
Okay.
That's why we clarify.
Ignoring that, BE doesn't cover its cash flow does not cover its dividend. Generates about $3.8 billion or pays $3.8 billion in dividends, about $3 billion in cash flow. So it's short, and that's, you don't have to be a genius. That's why they talk about cutting the dividend. Personally, I think they'll never cut the dividend. I think that's what has driven all the owners of BCE, to my knowledge. I don't own it. Can't remember ever owning it. For a little while, we did 20 years ago. I can't imagine that most of the owners are looking for dividends. So I would think the company would be very skeptical about cutting the dividend, because they're really shooting in the foot all the people who own the stock. Should they? I don't know because of that. The one thing I would say is, dividend or not, there are better dividend opportunities. So it wouldn't be my choice. And as I said, we don't own it, so I prove that.
Okay. Let's go to the phone lines. And Amy's on the line from Toronto. Hi, Amy.
Oh, hi, Richard. My question is on Definitive Financial Services. I own the stock, and I made a gain of probably 90%. There are a couple of times I really want to sell it. I don't know whether it should be a hold or just take the profit. Can you provide some advice, and I'll hang up and listen?
Okay, thanks, Amy. So Definity Financial. Let's have a look at the line chart as we talk about that.
Great. So this actually is very nice, because it fits into what I was saying 5 minutes ago about Manulife. I said the trick with these are big companies, insurance business. Definity, while an insurance company, is very different than Manulife. Manulife's a big company, we're operating a big industry. Definity has a strong balance sheet, and it's buying other smaller businesses. They have the ability to do that, build their platform out. So they have an opportunity in front of them that Manulife doesn't have. And Manulife, to make an acquisition, would have to be massive. Definity can buy, not mom and pops, but they can buy insurance companies and build out their businesses, which is what they've been doing. So we own the Definity. I like it. We have not sold it. So if you ask me if you should sell it, obviously we didn't sell it. So I guess that's the answer to that question. Whether we change our minds tomorrow, okay, I can't tell you, but I don't think so.
You see some more growth for them, so
they've got a market opportunity. And so, will they take it? The question is, are they taking advantage of it? Manulife doesn't. I mean, there's a big, huge market for buying mid-sized, small insurance companies, building out their business and building themselves into lines of business they're not in, that they want to be in.
Okay.
It's not gonna happen at Manulife.
Got it. Let's see if we can get to one more phone call before a break. Terry's on the line from Edmonton with his question. Hi, Terry.
Good day. Yeah, you're a breath of fresh air. Very knowledgeable man. Thank you very much. And my question's on REITs. The figure that the interest rates will go down now, do you think that'll help the Canadian REIT sector? Allied Properties, if you know anything about it. Thank you very much.
Thanks for your question, Terry. Allied Properties under REITs.
So I'll talk about REITs, and I'll talk about Allied.
Sure.
First, the real estate business has been stinky for the last couple of years. The only area that's been any good has been industrial, mostly pushed by Blackstone. which has been buying everything in sight. Other than that, it's been pretty terrible. Condo business in Toronto is dead. The office building, as everybody's reported ad nauseum, everybody's out of the office. They're moving back. They're moving back quite quickly in New York. They're moving back quite slowly in Toronto. I think it'll catch up. Most REITs in Canada exist because they pay a dividend. They have the business as a business isn't growing, developing, whatever you want to call it. So many of the REITs I would not go near. Allied is one I actually happen to really like. You picked on it by mistake. They have a wonderful, the only part of the office building that's any good is luxury. The high end. Okay. The high end in New York, as an example, is booming. Deloitte's yesterday it was announced they just took at $200 a square foot a whole building and to be built about to be built. Whereas the small buildings are devastated. And that's the same I believe it will be the same in Toronto. I believe people are going back to the market. If you look at the banks, they're all saying you must come back. It's moving slowly, slower than it has in New York, but it is happening, and it will happen in my view. See if I'm right. Allied has sort of top level buildings, but they're sort of edgy a bit, and so but they're still and they're quite inexpensive. So they're really good buildings. I think they get really good clients, and because they have a huge agglomeration everywhere they can move you from a 4,000 foot space to a 10,000 or a 40,000 without, which they've done with Shopify. And so, I really think they have a unique thing. They have a development plan and some wonderful development opportunities. At the moment, nobody's building anything, but they are there, and that will expand the business. It's good business, solid financials, great tenants, good properties, and it's cheap, and it yields. The dividend's not hugely well covered, but it's covered. I don't think the distributions will be cut. It's a lot, and it's good.
Got it. Okay, we are going to take another break, but Richard is sticking around. We'll go through his past picks when we come back. Welcome back to Market Call. We are going to go through past picks from Richard. These are from September of 2024. At the time, you picked Apollo Global Management, recommended at 108.67 American, now up to 139.24, so an upside return of 28%, total return 29%. What has been going on with Apollo?
Apollo is a private equity company primarily focused on an insurance product, annuities, and investing that in private credit, slightly higher rates of return, most of it investment grade, which is very good. Their business is growing at 20% a year. They got $750 billion or so under management. They're coming out next week with earnings. It's going to be probably up another 10%. Or if they're annualized, growing at about 20%, I should say that would be up 5%, I guess, from the last quarter. And I think this is going to continue for quite a while. So we like it. We own it. We've owned it for a long time, probably 10 years. If I told you what you'd be, I'm embarrassed to say what we paid for it because it was pretty low. But we're still holding it, and we have, and we like it a lot.
Got it. Okay, let's get to your next past pick from September, which was GFL waste disposal. At the time when you recommended it was 55.31. Now it is 67.65. So a 23% return and 23% upside total return as well. GFL is seeing growth for what reason? Any specific reason? Generally, organic growth?
By and large, I mean, in that one period, they were selling their water business. They've done it. They thought they'd get $6 billion. They got $6 billion. What they got in addition was the chance to keep 44% of that business because of the way they structured it, which was extremely good. If you think about it, they got like gross, almost 50% more than they expected. It is a wonderful business. It's run by really good people. It's got recurring cash flows. They're all all their contracts are, years. So it's just we think it's a lot more. It trades at a lower multiple than its major competitors. It's growing faster. It's got lots of opportunity to improve operations, which they've already done. So it's blocking and tackling pretty easy.
Is it a dividend stock? No dividend. Just some growth.
You're not buying the dividend.
Got it. Okay, let's move on to your last pick from September of last year, CI Financial. At the time you recommended it, it was $17.54, and now it's $31.24. So this one did very well. CI Financial returned 78%, total return of 81%. What has happened with them in the past, six or so months?
Simple takeover bid by Mubadal at $32.
There we go. And that got it a big upshoot. So are you going to hold on to it?
We sold it at $31.20, I think, a couple days ago. I mean, it's going out in the next few weeks, month, 2 months at $32.
Got it. Okay. So we will leave it there then with your past picks.
Not buying any of that one.
Got it. We'll leave it there with your past picks. We're going to line up more phone calls for Richard Fogler, Managing Director, Kingwest, and he's taking your questions today on North American equities. Back in a moment. Welcome back, and thanks again for joining us. Richard's here to take your questions. The next question comes from Fred, who's calling from Guelph in Ontario. Hi, Fred.
Good morning, Gal, or good afternoon, I guess it is. Richard, I'm 83, so I've been around this market for a few decades. And in 1972, a bunch of us were watching on the black and white TV Richard Nixon when he gave China favored nation status, and we all thought, oh boy, here's where we're in trouble. And sure enough, 50 years later, here we are. And the United States has got huge trade deficits because they send all their manufacturing over there so they can make more money. He put tariffs on Canadian products. That doesn't affect us. That affects the states. Their taxpayers are paying more for goods. But why are Canadian politicians putting tariffs on goods coming into our country? What's the point to it? All it's costing us is more money. Ford did the right thing. He took all of the bourbon from Kentucky off the Ontario shelves, and those guys are losing a lot of money. So maybe you could answer the question for a lot of us that are wondering what's going on here in Canada.
Thank you. So more of a political question. I'm not sure you can really answer that.
Let me see if I can dissect that. First, you made a statement that the tariffs hurt the Americans, an American consumer. That's true. Tariffs will be a charge to an American consumer.
But I guess they're retaliatory tariffs.
That's what I was just going to go to. Canada has decided, why should we let the American consumer suffer alone? We should make our Canadian consumers suffer with them. So we're going to show those guys, we're going to put tariffs on too. I was trained in economics. I was trained by people who believe in free trade. I believed everything they ever told me. The professors were very smart. I think this is ridiculous. I've listened to Peter Navarro, who's the spokesman for Trump. He is the single dumbest person I've ever met in my entire life. I never met him. If I did, I would say he's the dumbest person I've ever met. Everything he says is crazy. And I think Trump's making a big mistake. Everybody, Bessent and the Treasury Secretary, others say, these are our negotiating ploys. I believe you've seen the stock market, you've seen people. It's not been a positive response to Trump's tariffs. I believe Trump's gonna say, look at this. I made a deal with China. I made a deal with India. I made a deal with this.
It's all a setup. It's all a setup to an.
I'm a genius, and it's all. And meantime, nothing's going to happen.
Got it.
You said something about manufacturing. Understand that for the last 75 years, since the Second World War, manufacturing in every industrial nation in the world has declined as a percentage of GDP, and services increased. Anyone who has said that the United States is not that their economy has not been hurting, and that the U.S. consumer has not been hurting, knows more about the economics than the President of the United States. The U.S. has been the economy in the last 5 years, has been the envied economy in the world, and Trump decided it was bad, and he just turned a great economy into lower GDP, first time in 7 years, I think.
Got it.
And so I think it's all backwards. Manufacturing is not coming in the United States because they pay $25 an hour, and the Chinese pay $2, $3, $4. You don't have to be a genius to figure out where you'd want to buy stuff. Why do you think Amazon's buying everything in China, not in Des Moines?
Okay, let's leave it there, and we'll go back to the phone calls because we have Chris holding on the line. He's calling from, I think he's calling from Toronto. Hi, Chris.
Hey there. Actually, I'm calling from Regina.
Thank you very much. What's your question?
Just wanted to give the outlook on Air Canada, thinking about making an initial purchase.
Okay, so Air Canada has been sort of going into a deep dive. I think it's lower now than it was during COVID, the pandemic. So down to 14.11 at this point, a 30% drop over the year. Would you buy Air Canada at this? I mean, it's cheap, but would you buy it? Do you expect it to get a bounce back up, considering people are worried even about traveling at this point because of possibility of recession? Warren
Buffett said once that he would, if he had been alive and at Kitty Hawk when they flew the first plane, he would have done the world a lot of good by shooting it down. What he meant by that was airlines are a very, very tough business to invest in. They are highly volatile businesses, highly leveraged, so that creates even more leverage. The leverage of their businesses is very high in terms of occupancies, and then very high, and then cost, oil price all over the place, and then the leverage in the financial statements as well. That's not the kind of business we like. We have owned Air Canada, but we like businesses that have recurring revenues, that are forecastable, easy to play. This is you're guessing what's going to happen in the future. You want stocks low, it's probably going to go up. Like you say, it's cheaper than it was at COVID. There couldn't have been anything worse for the airline industry than COVID was. But in terms of fundamentally why it's going to happen, it's you're flipping the coin, and you'll be right or wrong. Okay,
there's the answer on that. Let's go back to the phones. Sylvain's on the line from Montreal. Hi, Sylvain. What's your question today?
Good afternoon. What is your outlook for TELUS? Thank you very much indeed.
Thanks for the question. So TELUS, another communications company, also struggling along with all the telcos, but it is doing something a little different, trying to sell some of its, I guess, hardware, or part of it, minority stake in it. Do you think that's going to work? Is that something that's going to work for them?
So let me tell you two things. One is we've owned telecommunications companies for 30 years. We've done great. They have done great. However, as I said before, we're looking for companies who have a massive opportunity in front of them. It is really simple. Everybody who wants to own a mobile phone owns a mobile phone. The opportunity, the market is not increasing. And so what's in front of a TELUS, it's not expensive. Like you say, they're trying to sell their towers in the States. That's been a huge business because it makes a lot of sense. You sell the tower to somebody else. You put other companies go on the tower, makes everything cheaper. Blah blah blah. But in Canada, where you've got a very tight oligopoly, it's a question of whether it's going to happen. And so I mean, they can fool around with the financial engineering a bit. But the core business is their telecommunications business going to get bigger in the next 10 years like it did in the last 10? I think the answer is simply no.
Okay, so let me ask you, because you said you've held telecommunications for a long time. Are you starting to get out of telecommunications?
We're pretty out. Well, we've got a couple. We've got some. I think we might own a little bit of TELUS still. We own some Quebecor, and we own the States T-Mobile. And those are all, and those are because they have unique things with their business relative to the others. But as the industry itself, the industry is, the opportunity, which has been massive for 30 years, has disappeared.
All right, we are going to take another quick break, but Richard's going to stay here to answer your questions. We're back in a moment. Welcome back to Market Call. We have Richard at the desk. He is here to answer your questions. Sal's been holding on to the line from Toronto. Hi, Sal.
Hi there. Yeah, my question is on Brookfield Infrastructure Partners. I was interested to know if this would be a good time to enter into a position now or to let some of the tariff issue settle down a bit. Thanks so much.
Are they affected much by the tariff situation?
Not really.
Okay.
They're the big thing. Infrastructure. So Brookfield Corp is a company that owns a bunch of private equity and has a bunch of investments. I'm going to talk about. I prefer Brookfield Corp if you want to buy something to Brookfield Infrastructure, and I do that for a couple of reasons. First, I think it's very cheap and very simple to figure out, and secondly, that's where all the management is and where the management has their money. We always like to invest next to the guy who's running the show. Brookfield Infrastructure is, however, in the private equity area, it is probably the fastest growing part of the business, along with credit. And Brookfield Infrastructure being the infrastructure section of Brookfield, I'd say that's also true. So it's certainly something that's going to continue to be, I think, quite a hot area. And Brookfield's been early in infrastructure; they're good at it, even relative to some of the other guys in the business. And, oh my God.
Oh, that's your phone. Okay, so Brookfield has been dragged down at the start of the year. Do you think it's gone down then just with everything else in the market drag? Because you said it doesn't really have a lot of exposure.
It got dragged for two things. One, it got dragged for that, drew all the private equity companies. You talked about Apollo at $139. That was a good call. It was an even better call 3 months ago when it was almost $200.
Okay.
So they've all been dragged down a lot in the last little bit, as well as KKR, which up a bit today because earnings came out, and Brookfield. But infrastructure is the hot part of the private equity business. So that's the good news. Brookfield Corp, however, is down 90 to 72, something like that. Don't hold me to those numbers exactly, but something like that. It's if they own infrastructure and a bunch of other pieces like that. If you add what they own of those public companies, that is about 80%, a little bit 85% of the value of Brookfield stock. Okay. They also own another $40 billion of other things. Their insurance business generates a few billion a year. It's a multi-billion-dollar business. Trophy office in the United States, in England, and Toronto. Some of the best retail in the United States, notwithstanding retail has been a tough area. They have very good, it's doing extremely well. If you add all that stuff up, it's another 40%. Brookfield's probably is 40% undervalued today, just adding up what it owns and what it's worth from what the stock's at.
Got it.
Plus, like all the other private equity companies, they're growing their assets at about 15% a year. So 5 years from now, they're just under $1 billion. Are going to be $2 billion.
Okay.
It's growing at 15% a year. It's cheap today. You could have a huge win in that thing. I think it's much better than infrastructure, but dividends not as big.
We'll talk some more about it to come. David's on the line. He's calling from Winnipeg today. Hi, David.
Hey, good afternoon. My question is related to recovery of markets, the scenario that we're in today. I'm in a personal RSP that's non-volatile, medium risk, like BlackRock, and it took 2 years to recover from the Eastern conflict, losing 15% to 2 years to recover. In this scenario, with the market tariff shuffling, how do you give a comment on that? How that looks?
Okay, so I guess what does the recovery look like to you?
I could say, to be funny, we are fundamental long-term investors at the moment. If you turn to a faith-based investor and hope like hell the market comes back, or pray the market, is probably a good thing to do. I think the market comes back. As I said at the opening of the statement, I think I like Canada. They have to do some things to make it work, but I think they're going to. I like the United States because I don't think Trump is actually going to screw up. He decided to screw it up. I think he can decide to not screw it up. I think the U.S. economy will do fine. And I think the stock markets will fall.
Okay, so a shorter recovery than what we've seen in the past.
Yeah, because it's a manufactured slowdown, so you can manufacture it not.
Got it. Undo this. Just
shut Trump up.
Let's take a quick break. We're going to come back. That's all the time we have for questions, but we're going to share the top picks, the new top picks from Richard. We're back in a moment. Welcome back. Richard Fogler here to share his top picks, his new ones. The first one at the top of the list is Brookfield Corporation. Richard, which we have talked a little bit about. You like it better than Brookfield Infrastructure, and it's mainly because it's got a better core business that you like?
It's more diversified, as I say. One of the things we like owner-operated companies. Or founder-led companies. Obviously, it's founder-led. It existed when Bruce Flatt took it over, but he's recreated the business. He's got a huge stake in it, billions of dollars. He's really good. And on top of it, as I said a moment ago, $110 billion roughly of market cap today, probably 150 plus of value there today, growing at 15% a year. That 150 could go to, could go to 300. 4 or 5 years from now, stocks trading at $74. These are Canadian numbers. Stocks trading at $74. Is that going to happen? I'm not so sure. Is it going to go up 4 times? No. Is there a lot of opportunity? Yes. It's a relatively new holding for us. We've only owned it 2.5 years. We think there's lots of room
for growth.
It's gonna. We like it a lot.
Do you remember what you bought it at? Roughly?
I do.
Can you give us an estimate?
I could tell you exactly, $42.
$42. Okay, so you've already done pretty well, and you're going to hang on to it.
We've done fine.
Got it. Okay, let's get to your next top pick, which is Uber Technologies, which I haven't talked about in a while. But Uber, what do you like about them as far as expansion goes? Do they have more places to bring the Uber technology?
Uber is simple. Stock got crushed. We bought it recently, probably the last 4 months. It's up a bit. But Uber is the largest ride-sharing company in the world, the largest delivery company in the world. They have a great business model. My son used that Uber Eats. He's in university. He's used Uber Eats to my death.
Yes, it's very popular.
It is very popular. Every night at 11 o'clock, they're delivering something to him. It could kill me.
And you're paying for it.
And I'm paying for it. That's exactly right. You got it bang on. So to a certain extent, we're trying to buy back the money I was paying. But sure. Joking aside, it is the core business. The business, in terms of profitability, was pretty weak. Dara Khosrowshahi took over 5 years ago. He has done a spectacular job. The business is currently going from a lost cash flow business to a rapidly rising business. Profits will rise, 30% a year for the next few years. When you say about market opportunity, ride sharing is slightly less than 1% of all driving. There's massive opportunity. The big opportunity is in robo-taxis. Tesla is trading at 135 times earnings, partially because of that. Waymo, and they have none on the road. Waymo is in 7 cities, adding another 3 or 4 this year, and is worth 0 in Alphabet. So we like Alphabet too for that reason. Skipping back to this, we think this is going to we think this is going to continue to do very well. They are primarily in big cities.
Okay.
Uber, there are small cities to expand into. There's lots of opportunity, lots of growth, and and they're the main player. We think it's going to do extremely well.
Got it. Okay, let's get to your next pick, which is Secure Waste Infrastructure on the TSX. What do you like about Secure Waste at this point?
So now we're talking about a smaller company. Secure is in in the metal waste business, the water waste business, and they've got a small pipeline business. The small pipeline business is essentially a legacy business, does really well, generates good free cash and from operations, and it's a good solid business. Because it was in that business, it's largely covered by our energy service analysts. Energy services trade around 10 times earnings. But most of the business, 80 some odd percent of the business, is in waste management. What do? They metal recycling and water recycling, and the water recycling is related to the oil business, but not in the drill bit business, which goes like this. It's in the mature oil business. So you've got drill bits going like this, and you got water going like that. You got as a well matures, they generate more water and less oil. And that water waste has to be, so these guys are doing it. So it's a recurring revenue business. It's very simple. Gradually, that company is being covered by industrials analysts as opposed to energy analysts. I think that's the base of our purchase, but it should swing. If it swings to being considered a waste business, which is what it is, as opposed to an energy business, the multiple goes up by 60%. Meantime, the thing's growing at 15% a year, 4 or 5% from just economic growth, another 6% from dividends. They've announced a 6% stock repurchase on April 8th, another 5-6% for acquisitions.
Okay.
So 10-15% a year growth, cheap as hell right now.
That's why you're
what we
debating.
like.
Okay, we got to leave it there. We're out of time. Thank you for sharing your top picks. Thank you for coming in today. Appreciate that.
Thanks for having me.
That's all the time we have on Market Call, and thank you very much for sharing some of your time. We'll see you again tomorrow.